the dividend hits your account, it gets reinvested. But I'd say, really, how much money did you tie up for that? I want growth exposure. I want to capture 92% of the growth in the market. If I do that, I win. You feel like you're a late starter. You're like, oh no, what did I do in my 20s and 30s? I'm so far behind. The temptation in your 40s, some cases 50s, people will start out even riskier than they need to be because it's like, no, I have got to buy this AI stock and put the 50,000 I have in it today on this one because I got to turn this thing to $1 million. I don't have to be right of what's going to happen next. I don't have to predict the next scene in the movie. It doesn't make a difference. I'm ready for it either way. The smart guy who is long term and buys through it, they might not feel smart today, but they'll be smart in the end.
Investors, welcome back to another go-round worth of Masters of the Market. This week, I'm incredibly excited to have on with me Tom from the Investing Tiger. He's got a podcast of his own, one heck of a Twitter or X account, and he used to be a former wealth advisor. So Tom, I am incredibly honored to have you on Masters of the Market. I want to pass the first question right over to you, as I always do, and just ask you about your story and how exactly you got to where you are today.
Ari, first, thanks for having me on. Holy cow. What a month it has been in the market. I'm sure we're going to talk a little bit about that. There's so many lessons within lessons, I think, to learn, and probably that we'll still have to learn. So that's kind of my story. I've been doing this. I started investing back in the Stone Ages, the dark ages of let's call it 1991. Can you believe that? There's just been so much that I've learned along the way, seen along the way, but guess what? Still see new stuff day in and every day. I think just over time, it just gives you, like when you see something happening now or what they were calling crises a year or so ago, over time, I think you just it's like, oh, I recognize this one. This is a lot like 1995 or 1998. And you just have a reference point to compare it to. But I started out working in the industry, a lot of different roles, handling individuals' money, running large investment, from a wealth advisor standpoint, investing groups, financial planning, and did leave the industry about 2 years ago. And after 30 something years, I feel like I can finally talk about it, because when you're in the industry, I was very restricted what I could say, what I could offer. And here we are. That's my story, and I'm sticking to it.
I want to dig in a little bit more. What made you head in the financial direction in the first place?
That's a really good question. All right. Sometimes I sit back and contemplate, would I have started investing if I didn't start in the industry? So would I personally have been an investor in basically once I got into the industry? I don't know. I mean, I probably would eventually have, but I wouldn't have been informed. But I guess what drew me to the industry was, I wish I could say it was, at 10 years old, there was such a great influence in my life and I knew exactly what I wanted to do. No, that's not me. If that's the answer you're looking for, that's not my answer. I'd say the closest thing to it, which attracted to me to the industry at a young age, was I guess when I was about 12 or so, my older sister was dating a person who was called a stockbroker at a firm that no longer exists, Beige Securities, which was bought out by Prudential Aviation. When he'd come by, he'd always have like a Barron's, an old copy paper of the Barron's or the Wall Street Journal in hand, and I was just fascinated looking at all the different stock quotes. Like that was like the timely information when he was coming by on the weekend with. In addition of the Wall Street Journal from the week. That was my exposure to the stock market. But I graduated. I graduated college. I always joked I couldn't find anything else to do, so I became a stockbroker.
I feel like so many people find their, I want to say path in life just by stumbling across it and then they just stick to it. Tom, you mentioned a lot from the get-go in terms of, having all this experience in the industry, not really being able to talk about it while working in the industry, but now having the sigh of relief to be able to talk about it. Can you share a little bit more about that?
Yeah, absolutely. So, in a lot of cases, especially when you work with a large organization, what you communicate on places like social media, a podcast platform, YouTube, it's very restricted, because basically how you communicate with the public while at work and outside of work, there really is no separation. in FINRA's eyes. And a lot of internal compliance departments do monitor for that stuff. So that's kind of the stranglehold that I faced. Just wasn't worth it. Felt like I had something to say, a story to share, but just couldn't share it publicly. And you know what, Ari? To this day, I think that has made me better in this space because I don't run a channel or a page on X that says 5 stocks to buy now, 5 stocks to avoid. I don't know. I don't know the true outcome of those stocks, and I don't know the person on the consuming that. I don't know their situation. The 5 best stocks in the world to buy could be the worst for them. I don't know their financial situation. So I still respect that level. It's a level of sanctity that I still have. Instead, what I try to do is a more sensible approach. Gee, if your end goal is financial independence, not being destitute, you don't have too many other choices. There's 2 choices. Pick your difficult, kind of blunt, but that's kind of how I think about it.
No, look, it makes a lot of sense. There's a lot of creators out there who are posting content of the 5 stocks to buy now, or, we've seen a lot of this rather recently just based on the state of the market. The market's done forever. And so, again, you never know who's consuming it on the other end and how they're reacting to it. I'm curious to get your standpoint on, for viewers out there, how should they know who to trust on the internet, and should they be trusting anybody at all?
I think you know it. I was having a discussion about something similar to this, Ari, the other day. It wasn't related to investing. So I would use this. It's almost a mindset of disqualified to qualify. Take that mindset with things. Don't trust everything. So who can you trust? I would say if someone comes at you in a real salesy approach, probably should have your radar up. What I would like to say is a more consultative approach. Then that person has your interest in mind. And the way you could detect that, so that sounds good. There's a lot of good buzzwords, but how would you detect that? If they're telling you, they probably don't have your best interest in mind. If they lead with asking first, maybe then we can go somewhere. They're taking you down a certain path. But things can still go wrong. They could be trying to entrap you in something, but they at least have your interest, expressing some sort of your interest at heart.
It's interesting you say that. A lot of the videos that I've been creating rather recently, I'm always mentioning what I call the investor profile and how important it is for an investor, not to stumble across a video or an article and just throw their money at a stock because it's listed, but rather consider their investor profile, which is how old they are, their investment timeline, their risk tolerance level. I'm curious to get, one, your take on what exactly a good investor profile looks like at varying ages, and 2, how an investor should use such a profile to begin investing.
Yeah. So I think there's moving parts within that moving part. Sometimes age is one proxy. I think there's a few other things that go into it, but I appreciate the spirit of the question. So the way I would think about it is a little along the approach of, I think what we've seen maybe the last couple of years and very much late last year and early this year, most people had an approach: buy first, ask questions later. I think we started to see a little bit this past month, and maybe sell first, ask questions later. So right there, that tells you a clue. You went into whatever your profile is, you went into it the wrong path. You did no qualification up front or proper qualification. So I did an episode on this, and I think it was newfound information to a lot of people. And it's something I do personally by portfolio design, because it gives me a sense of my personal volatility that I'm able to withstand. And what I do is I called the episode "Know Your Beta Alligator," and it was simple: just figure out what your overall beta is on your portfolio. Well, if you got a beta of 1.3, and I'll just explain what that is quickly. 1 is the S&P 500. That's the market. That's the benchmark. In simple terms, if you have a beta of 1.3 in that example, you should expect volatility 30% greater than the market. So play that out. Let's play that out. Ari, we've been in a volatile market lately, right? Doesn't make you feel good, right? Well, how would you feel like if your volatility was 30% higher than that? Could you really withstand it on the downside? At my age, no, and I don't need to. So going back to your original question, the profile, that's one way to back into your profile. of figuring out where you are. If I were 26, 28 years old, once again, about half my age, that wouldn't bother me at all. I could own a whole portfolio of Mag 7 type stocks. But at my age, I don't need to take that risk. So I just own some exposure on the individual level. And of course, what I own in the indexes. I run a beta of 0.92. So when the market falls apart, there's some of my individual holdings holding everything up and actually rallying through it while the other growth stories suffer for a period.
Tom, have you, throughout your experience, I mean, 3 decades, have you had to walk a lot of investors through this to say, like, let's talk about the beta of your portfolio? Because I feel like, from what I've seen at least, a lot of investors, irregardless of the age, are just jumping in to the market to grab hold of a stock or two in hopes that, of course, it rises. But that's, again, where you're going to catch yourself in a bit of a trap.
Sometimes, some people, that gets a little bit too, all right, beta, now it sounds like you're talking, we're throwing Greek letters in here. Uh-oh, you've lost me already. I knew this investing was difficult. I better not do it. So you do have to have some sensitivity, but you can get there without being like the technical investor geek to a person that is not fluent in investing. So then it's just like, almost like the way you would ask questions to a child. Tell me where it hurts. Tell me what you're feeling. How would you feel if this happened? And you can build up that risk profile pretty quickly to couple it. But you also have to. The biggest thing I've noticed is most people we're very brave when we're not staring down the edge of a cliff, aren't we?
Sure.
Before we get on the roller coaster. Before the hazard takes place. Well, I'm very brave then.
Waiting in line for that roller coaster. It's going to be great.
Yeah, exactly.
So let me ask you this. A lot of investors who are then approaching the market for the first time, whether that's a younger investor or an older investor, where exactly should they start? Like, where's the ideal place to start? Is it with individual stocks, or do you think it's ETFs or mixing and matching?
So assuming they went through the jump in profile, can they start? Let's assume they answered that question. If they don't have as we just found out this month, if you don't have a suitable amount of money in savings for the transmission that goes out, a big leak in your house, you're not starting investing at this point. You gotta shore up those needs. But assuming that's met, why place all your chips on one bet, right? So this isn't original thought, but I fully support until you get to a certain level, 10,000, maybe for some it's 100,000, just go into a broad-based equity fund. My choice has always been U.S. equity funds. I know the past few weeks, this year, international is getting a lot more love than we've seen in pretty much decades. Maybe it is true reversion to the mean. I don't know, but I'd start down that path first, Ari.
So with that being said, does that matter how old someone is then?
Yeah, I would think from an age standpoint, I'd be pretty age neutral on that. If a person's in their early 20s, we know the story fantastic. You've got time on your side. Still start in index funds. But if you feel like you're a late starter, you're like, oh no, what did I do in my 20s and 30s? I'm so far behind. The temptation in your 40s, some cases 50s, people will start out even riskier than they need to be because it's like, no, I have got to buy this AI stock and put the 50,000 I have in it today on this one because I got to turn this thing to 1 million because I didn't invest earlier. I'd still say no. I'd say can't make up. You can try making up for lost time, but you might not be able to.
At that point, it's almost like going to Vegas, like taking your 50,000, going to Vegas. Let's make up for the lost time and see what happens.
It really is.
Okay, on the opposite end of the spectrum, I've had a lot of younger investors, whether on the show or just fellow creators creating content. We're always talking about, these days, passive income, generating passive income, investing into dividend stocks. Now, I, for one, years back, threw a lot of money into dividend stocks. And had slowly transitioned more into dividend growth stocks and then just growth stocks. I'm curious to get your take on young investors, early 20s or mid 20s, late 20s. building up these dividend portfolios?
I think there's worse things you can do. So I'll start there. All right. So because I always say don't do it. I didn't do it. That fit me. I focused on growth in my 20s and 30s. I didn't buy my first true dividend stock well into my 30s. And I bought a couple, and it was such a small portion of my portfolio then. But I don't see the wisdom in. Sometimes I see 20-something-year-old investors, and they're just trying to buy dividend stocks that are yielding 5% plus, like non-growing companies. They're exposing so much of their principal for just a little bit of dividends. And I know it can make you feel great. Oh, I got that quarterly dividend of $27.12 passive income. That's exciting because that's a monumental, tangible event, right? The dividend hits your account, it gets reinvested. But I'd say, really, how much money did you tie up for that? Could you have gotten better growth? I'd say lead with growth and truly focus on a more dividend-oriented portfolio. Scale it down a little bit and become more dividend-focused as you get older. I'm 50-something now, 56, and I love my dividends. All right, but I still don't consider myself a true dividend investor, as some channels, some accounts. I don't post my dividends. I've reinvested every dividend in my life. I get some pretty nice large dividends that eventually I will live off of maybe in 10 years. But I'm still going for growth. I want growth exposure. I want to capture 92% of the growth in the market. If I do that, I win.
What do you think it is about these dividend stocks? Like, it almost seems like all of the sudden there's such a big movement now, like with generating passive income, retire early. Do you think it's that kind of movement, that thought process that's captured a lot of us into the dividend movement?
I think so. I pose the question once in a while to young investors. I post it online, just try to understand it. I think there is something, that electrifying feeling of getting a dividend. I think there is maybe more distrust in the system. I can't buy a house. It's difficult to buy a house. A person I know worked at a company for 2 years and was let go, and they can't find a job. So there's no surety in other things, but they feel, this company's been paying a dividend uninterrupted and it's grown it for 57 years. I can trust in that. I think that's maybe a simplified explanation of it. And, like I said, the first thing I mentioned was, I think there are worse things a person in their 20s can do with their money. So I'm not trying to banish people from the island if they're 24 years old and focusing on dividends, but it's just my thought.
Yeah, it's interesting because I agree with you. It's like you could be doing worse things with your money. At least you're investing, and at least you are generating,
Yeah.
income, and you're hopefully, growing your portfolio. If not, that's another problem. But at the same token, you could just be doing it better. You could be gaining more, capitalizing on growth opportunities. I'd love to get your opinion on what you think, and I'll give you the two avatars for it. Avatar A, the young investor in their 20s, 30s, and then Avatar B, the investor who's perhaps in their 40s through 60s. What would be the biggest mistakes you're seeing between these investors? Surely they have to be different types of mistakes, I'd imagine.
They could be, I think, but when you say the biggest, I'm not sure if it's the biggest, but it is one of the biggest. And I think the same mistake applies to both avatars. And you know what that mistake is? Let me not keep you in suspense. It's right up here. It's how they act. It's down here. I'm pointing to my stomach, and now I'm pointing to my heart. It's the anatomy. It's how we handle emotions. And I don't think the market went down and was very volatile for 20-year-olds this past month and 60-year-olds. So I would say there's a commonality of what's going on with it. And I think how people handle their emotions on the front end before there's a correction, and during it, that's going to determine their level of success longer term. I think I hate to give you such a simple answer. I wish I could give you something more. I love numbers, something more technical, but a lot of things with investing, I think, can more simply be explained and attributed to it's as simple as that.
was going to say sometimes we don't have to overthink it. It really is that simple. And so not overthinking is the best choice of action that we can take. Let's talk about the market right now. I mean, where we stand today, because there's a lot of emotions that are out there. That's for sure. We're seeing a lot of selling, then buying
Yeah.
opportunities that have come about. What's your take on the market right now, and how should we be going about even investing? Should we be concerned? Should we be, worried?
I think people much, much smarter than me can give a answer that can be just as right or wrong as I potentially can think through it. So I kind of recognize that in the room. But one of the things I teach on my channel, Ari, and I knew the day was going to come, and it did come. 6 months ago, a year ago, I was talking about on the front end, while the market's up high, giving people tips on how to gauge risk tolerance for when it happens. Kind of get ready for the hurricane before the hurricane warning hits. Then it's too late. Then you got to have everything on hand. Hard to figure out a plan in the emergency. Knowing beta, so a couple tools like that. So I think the time to prepare is not like kind of when we're going through it or trying to figure out what's happening next. What's right for you, your risk tolerance, companies you feel strongly about, investments you want to anchor your portfolio, because that's real important. Things like ETFs. What do you want those to be for when the time comes? So now, the liberating act of doing that, Ari, is guess what? I don't have to be right of what's going to happen next. I don't have to predict the next scene in the movie. It doesn't make a difference. I'm ready for it either way. I can accept it. Well, when people say, well, that's great, Tom, but what if, name the worst event that can happen. What if we do have this debt crisis and money is truly worthless? Well, I mean, if that's your extreme case and story, I'm sorry, I can't help you. No matter what you do, you're not going to get ready for that. So you can't get ready for something. You can't get ready for an anvil that's going to drop on your head that you don't see coming. I mean, there's no cure for that. But very unlikely. Don't try to apply this. You're going to get wiped out by the most unlikely of events. So I get very long-winded on this topic because this is investing. This is what it comes down to. I was laughing. I knew we were February 18th. I put a cryptic post on X, something like, I don't worry about when people are talking about recession. I worry when they're not. And don't you know, the next day the market topped. No way am I trying to say I called the top of the market. I guess if I was a better marketer of myself, I could say I did call it, but that's not the case. The point was it was just listening to what the environment around us is telling us. And don't you know, how many times have we heard the word recession the last few weeks? It's all everyone's talking about. Okay, well, the market went down with it. So now I'm actually going to record an episode specific on this. It's going to be a much more synthesized but long approach on what I think the market's going to happen. And when I think of what's driving the market down lower right now, and what does, I think you have to, may not be my base case of what happens next, but everything driving the market lower right now is only the negative side of the coin. Tariffs, recession, slowing economy, and I'm sure we can dream up a much longer list of that. So my thinking would be, well, what if one or none of those things really materialize to dampen the economy? Then what would happen with the market? See, I think if you have to think all of those things that can happen, and usually when the list is publicized and it's being talked about, that's usually not when you have to worry about anything or any big. It's the blind spots that usually tank the market when there's a true structural breakdown. Personally, I'm not seeing it. I'm an optimist by nature. My handle on X is the investing tiger, and what that means is I'm not truly a bull. I'm not a bear. I'm more of a tiger. I'm ready to pounce and act where and if needed, but I'll sit back. So I think I bring a more level-headed approach to this than a true bull or bear does. But that's what I'm trying to say, Ari. If I would just sum it up by saying, get ready beforehand. You could probably handle what's happening if you are. And then when there's only the negative outcomes being talked about, there's a chance. You have to entertain the chance it doesn't materialize, it doesn't become a contagion, then the market can recover. So I think you have to give that, and that's why I say the smart guy who is long term and buys through it, they're going to be, they might not feel smart today, but they'll be smart in the end.
I love that, and I also love a couple of the buzzwords you actually threw around, inclusive of the tiger analogy, if you will, talking about not being the bear but not being the bull. And then you use the word optimist as well. And when you used the word optimist, Warren Buffett came to mind for me because he often always talks about being an optimist and believing in America. How necessary do you think it is for your success in the market to be an optimist?
Yeah, I think sometimes optimist, and it gets a negative connotation when it comes to investing. So, and where that breaks down is I think you do have to be optimistic with your investing approach that things will work out, and it's more of a longer term optimism. I don't care what the market does next week, March 17th, when it reopens again. That's indifferent to me. Flip a coin, it's either going to go up or down. Who knows? But I think where people, it's a false dichotomy when they say, oh yeah, you can't, if you're an optimist, you're not a realist because not all stocks go up. And, they start throwing out these rebuttals to it. My response would be, one, I'm not buying all stocks, right? I'm sticking with what I know, what I'm comfortable in, and have conviction on the front end. And it's because of that I have optimism. If I were buying names like, I don't even want to mention specific names, a stock that went parabolic on little to no earnings that got well accepted, I probably wouldn't be optimistic then. I'd be cautious. So that's why I think optimism is not being a reckless investor. But if I've owned Walmart, I'll throw that name out there, which I have since 2001, 2002, yeah, I'm optimistic. I'm optimistic now, like I was then, and it wherever my estate lands up, it'll probably still be in there then, the stock, and hopefully my heirs are optimistic of what they've inherited at that time. But that's what I mean by optimism. I'm not going to worry about a tariff. I have met very few people that can give me a really good explanation on tariffs. It sounds good. Well, I'll end up paying more. It's going to cancel trade and crash things. But what if that doesn't happen? What if it's such a complex topic? We try to simplify it in our minds, thinking we're going to wreck global trade and the U.S. economy in the process. Well, but would it get to that? That's always my question. How do you know that's going to be the end result? Just because that word's brought up, and I can't base my life on an approach of the most sinister worst case outcome. You'll never be a long-term investor, and there's nothing wrong with that. There's a bank on every corner, plenty of online offerings that will pay 4.5% or so in a high yield savings account. I don't know what else to say.
I want to construct a portfolio with you, and in this regard, talk about how to actually select stocks to put into your portfolio if you are going in that stock picking direction. There's thousands of stock opportunities out there. And I feel like one of the biggest issues that a lot of newer investors have, and even more experienced investors have, is how to know which stocks to put in your portfolio. What are some of the metrics that we should be looking at? And what stocks should we stray away from?
I want to say this one important thing before I forget. Because this is, I think, a very timely thing that most people are, I've seen this on X specifically, a high-flying stock, it looks cheap. It's gone down 60% in a month or so. But it's not high quality. What I mean by that, maybe it doesn't have earnings. It never should have been 3 times as high as it was before it fell. Well, it looks cheap. I'm going to buy that now. Don't do that in this market. You'll get punished. You're taking a gamble. When quality is cheaper, names like Amazon, Google, if you want to speculate, I'd say even Tesla, which I own, at these levels, place a bet on something like that, it's much more likely to be eternal. So I just wanted to share that kind of Surgeon General's warning on how to approach investing. So I don't think maybe a newer investor realizes some of these stocks never come back. Every generation has their stocks that wash out. But how would I start a portfolio? I'm glad you asked that. So on the show, what I ended up doing, this is kind of silly. She's just to the right of me. She's taking a nap right now, Radish. So on my podcast, Radish is she's the hardest working producer, hardest working dog in podcasting. She's my producer, I call her. So we set up it's a real portfolio, real money in that. And about a year ago, we started her account. She was a new investor, and I put like $25 a week in it. She has a few $1,000s in there now. So I set this portfolio up for two reasons. One, it is a tracking index of my larger portfolio. She owns the ETFs and stocks I own. And I do that. I don't publicly share amounts. I think, it's just my style. I don't see a winning outcome to that. Either you got lucky and you have too much, or I would have done better. Why do you own that name or done that? So, but that's beside the point. So how I approach the portfolio construction is we started up her portfolio. She's got two ETFs, which are my two largest ETFs, VTI, the Vanguard Total Stock Market Index. Those represent 75% of her invested funds. No, that's not 75%. 75% of the funds are the ETFs. Of VTI, the other one is SCHD. So I get some non-overlap there. And if the audience doesn't know that word, that's real important with ETFs or really anything you buy. You don't want to diversify into four of basically the same things. QQQ looks a lot like VTI. That wouldn't have diversified me. So we went with the SCHD to pick up income. So 75% of our money is in those two ETFs. And then we have a basket of 10 stocks. They're mostly, one of the big things I talk about is shareholder yield. We were talking about dividends earlier, and I really get attracted to companies that have what I call a higher shareholder yield. A dividend, a growing dividend, but they're paying a lot. They're buying their stock back. That's powerful. So I've got names like Costco in there, Walmart, Apple, own that one a long time. And then we'll get a little bit more exotic. We have names in there like Tesla. I mean, Tesla is either going to be $1,000 stock or $100 stock, in my opinion. It's going to go either way. People that just value it on today as a car maker, I don't think so. I don't think so. There's a lot of upside there. If it materializes, it does well. If it doesn't, it's a very overpriced car company in this environment. And then there's just stable names that, I mentioned Walmart, Coca-Cola, which I've owned since 2000, basically 2001. Those just buttress the account and keep it stabilized in an environment like that. But the thing we'll be talking about probably in this week's podcast is, regardless of how well you are, still deposit into every week. And I remember this in the Great Recession, Ari. I kept seeing that money getting taken out of my paycheck, putting money in my investments, and the market went down. It went down week after week, year after year. It seemed to always go down. It felt like I was just putting money into a furnace, just watching it burn, till suddenly we bottomed and we were on the other side. So I don't mention the specific names. I don't architect it as simple as, buy these 12 names and you've got yourself the right portfolio, because I don't know what those names are. But instead, I give people the tools to how to think through it. So all I've done with Radish's portfolio and mine is 75% of it is in ETFs. I can't blow myself up. I'm protecting myself from that measure. And then there's 10 or 12 stocks. I sell very few times. And that's another big aspect of it. I don't buy on the front end, regardless of what you buy. If I don't think I'm going to own it forever, I don't own it for a minute. I'm open to sell it, but I've got to go in. Again, it's that disqualify to qualify before I buy anything. There's 4,000 stocks out there. You don't have to look at every one of them, nor own every one of them. But If I've built up a good portfolio and it's diversified, I don't have to go in and out. And it was 2,788 days without selling a stock up until recently. I finally sold a stock at a double about 8 months ago. No longer had conviction in it. The story had changed. It could go up a lot, but it wasn't why I bought it anymore. Moved on, headed to higher ground. So I've said a lot there, rambled a bit through it, but does that make sense?
It absolutely does. I want to double down on what you just mentioned with the sell, because you said you lost conviction. Now, when it comes to selling a stock, and I know so many people who get attached to their stocks, they get married to them, they watch these things tank, lose all their money sometimes, unfortunately. So this begs the question: how do we know when to sell? I mean, yeah, if we
Yeah.
lose conviction in it, that's definitely a red flag. But let's just say it's
Yeah.
still performing well. Is that still a sell in your book?
It could be. I think some people have. I wouldn't say never sell. One move is you never lose money by taking a profit. Maybe in certain cases, take your original investment out of it. Let the profits ride. But you have to entertain the switching risk, like where you go next. Do you think you can do better? Um, so if I sell, I'll use an example. If I sell Coca-Cola here, owned it for 20 something years, and most of this is in, let's not even worry about taxes. Most of this is in tax deferred accounts. Where do I go next? Well, I know the way I've constructed my portfolio, I'm replacing that with a company that looks like Coca-Cola, just from a diversification standpoint. Remember, we talked about beta. So it's not like I'm going to sell it and all of a sudden I'm going to buy a semiconductor stock or I'm going to buy an AI stock. I'm not going in that direction. I'm probably going another household consumer goods name. So then I started thinking, well, why am I going to sell Coca-Cola? Just because I'm up a lot in it because something else looks better. No need to trade that car in. This one works perfectly fine. No chance of a better outcome. But where I would sell it is, let's say you did all your legwork up front and it was a dividend paying stock and everything was fine. The dividend looked well covered, sales looked great. Maybe I'm talking about Walgreens circa. I can think of compelling research reports when I was in the business that would come out of our analyst at Walgreens is a great American name. And now look at them, right? Going private anyhow, but last few years have been miserable. Dividend wasn't well covered. They had to cut their dividend. Well, if you start getting in that situation, don't fight. Don't fight it. It's no longer the company you bought. No longer the company you bought. And that that's why it's hard to build. To your earlier point, that's why it's hard to build a portfolio of individual stocks exclusively without getting a foundation in front. That's why I like to see people go into diversification ETFs up front.
So now you shared that in building a portfolio, at least with the two that we were talking about on your end, it's 75% in ETFs. I want to know when you actually put money in to the market, how do you know where to actually allocate that money on a week to week or
Yep.
a month to month basis? Because I think that could be confusing for some investors. Do you put
Yep.
it into the ETFs? Do you go with the individual stocks? How do you know how to splice it?
Great question. So I use radishes. I'm glad you brought that up. I got sidetracked and forgot to mention it. So every week, um, we deposit money in radishes account. Every, I already have the buys entered for Monday morning. The deposit took place last night. The buys are going. I don't care what the market opens up on Monday. So her two buys are going to be a split between VTI and SCHD on Monday morning. That's it. Simple as that. That's the automated part. Now, the 10 stocks in her account, what I'll do, I'll give you an example here. Let me look at a couple names. A month or so ago, what were we buying? I remember it was around the Super Bowl. We were buying Hershey in the 140s and 150s. That's one of our holdings. What else was beaten up? Basically, a month, 4 to 6 weeks ago, if it was value, it was beaten up. Hershey came to mind. So the excess cash in the account still had conviction in Hershey, although I jokingly called it the big chocolate mess because it was really down with cocoa prices and a few other headwinds. But don't you know that we've been hovering in between 170 to 180 in that stock now. So where I've been deploying money recently is some of my more growth stocks I still have conviction in that have gotten beaten up. One of those names is Kava, if you're familiar with Kava. Love the company.
Sure.
Been in it since the low or the high 20s, low 30s, and done a few episodes on it. And, I still have conviction of it, especially here in the high 70s to low 80s, because when it broke to the 140s, I said, this has got $70 written all over it again. I'm going to keep buying it. So that's what we've been buying the last couple of weeks. So that's how I kind of decide. It's a bit of a round robin. That's where the Investing Tiger name comes from. I'll pounce. I know where I'm going to pounce and what I'm going to pounce on. I just don't know when. But that's the way we approach it.
So in which case, do you have a stock watch list ready to go in order to pounce on those opportunities? And if so, how many stocks are you watching at any given time?
Pretty much just the ones I own. That's why I keep a portfolio of 12. And it's a really good question. Some people will diversify and say, well, I'll just buy 50 stocks. I mean, I know people have had 130 stocks in your portfolio. And I'm like, good gosh, that's a lot of babysitting. How could you watch that many companies? And then, I always think, well, gee, is your 120th pick as good as your top 5 or 10 picks, top ideas in your portfolio? So it really is not that hard. It's nothing more than watching my watch list on my phone or logging into my account and just saying, okay, these are where they are. And I usually have the price point set. Like I probably should have bought more Tesla last week, didn't it? 229. That was my target. I missed it. I usually buy it when it has a big pullback. But if we see a little more weakness in it, we'll buy it then. So I have this watch list written down kind of in my head before the event happens, so I know what I'm looking for. But I don't want to simplify it that much. That's the price aspect of it. I also want to look at what's driving it, why it's going down, because I don't want to catch a falling knife if that's the case. And I will look at the chart. I do know how to at least read or interpret charts to see where support is, where resistance is going to break down.
I'm happy that you mentioned, those individuals out there, investors who are building these portfolios of 100, 130 plus holdings and saying that that's diversification. I've actually created more videos rather recently just to say, be very cautious when you do that. And then to your point, is that 130th pick as good as your first 5? I would argue not. But there's so many investors out there who would argue, no, it's the way you build a portfolio. And this is how you protect yourself. So where do you think that this kind of, insight creep came from? And how do we help investors understand that that's not the best approach?
If you can do it, great. Who am I to judge? But I have seen how difficult it is. And I know us as human beings. I love doing this when when I have free time. I spend a lot of time looking at stocks, and I know how much time it takes. I can't imagine that many more people out there really have that much availability. I wouldn't want to do that to myself. I would rather build up and have an index fund and do it. But the NFL draft is coming up, and once you get down to that 7th round, right, the last and final round, and someone's waiting to hear their name called. They hope their agent got a call from the other team. Do you really want your stock portfolio consisting of 7th round picks? Is that what you want to build your team around? So sorry to use a sports analogy. I hope that connects with some people in the audience, but you start getting down to the bottom, it's the I mean, just mathematically, you have to be lowering your selectivity I think.
Sure. I mean, look, I know this whole notion comes out of a place of fear and what doesn't, these days if people are either doing, loading up their portfolio with a bunch of stocks or not even getting invested at all. So I guess my next question, given your experience, 3 decades in the industry, is there any tips that you can give us on overcoming fear?
Um, Overcoming it. I I posted something the other day, and it drove the point home. It was as simple as this. It was just being able to recognize and accept these 2 points. This correction, hopefully, it's all we see. Maybe it becomes into a 20% correction, but when we hit the 10% mark, I added up. I was like, damn, this is my 19th correction I've been through. And I'm thinking, well, that's only 30 something years. Right. So I just wrote it. Are corrections fun? No. Do I expect them to happen? Yes. Am I worried? No. I mean, out of the 19, I'm 18 for 19. 18 of the 19 times it recovered and then some. It took time. The worst was the Great Recession. Um, we'll see if this one recovers too, but I like those odds, 18 for 19. I'll keep riding that bet because going in every time, guess what? It was just like this. It wasn't supposed to recover. Oh, the stories sound so good, Ari. Oh, they sound good. This is different. The velocity of this correction, the overvaluation of it. You name every story. There's some beautiful charts out there that illustrate this, but there always are. There was always such a tremendous amount. Uh, you're sitting back trying to overcome fear, and there's an equity desk out there, a research analyst putting something together that's just going to exacerbate that fear for you and leave you into action. It'd be like sitting back and watching TikTok videos all day that just poison your mind, take you away from your goal. So I think that's so important to know yourself, limit what you can consume. For me, I keep CNBC, Bloomberg, or Fox Business on all day because somebody said, I couldn't do that. It's just negative on these down days. But I tell you what, I can, investor sentiment's very interesting for me to follow. And, when things are too positive, I'm more worried. When things get overly negative, I stop worrying as much. And so I tried putting a post out the other day, just gauging the sentiment of where the average investor was, and I asked a simple question: will the S&P hit 5,000 first or 6,000? Well, what I was hoping to see was a really big break. I was hoping to see potentially a lot of pessimism, 60 something, 70% of people saying, oh, we got more to go. And don't you know, drats. It was almost a 50-50 directional because I could have piled on mentally on one side more as the next move. Uh, Although I don't really, as I said earlier, I don't really change what I'm doing based on the true direction of the market. Um, just that pulse check, but um, just it's the zoom out factor. Think of why you started investing. Does it still hold true? Have your goals changed? Probably not. You're going to need to retire, mm, you know, prepare for less income later in life and need to replace it. If those are still your goals, you really don't have too many other options out there. You better be extremely talented at something. If you can't build it yourself, you better build it on the backs of your investments.
So it was interesting to me is you shared that you have, CNBC on and you're always listening in to what's going on in the world. And you have a lot of investors who say, I don't even pay attention whatsoever to the news and they're just dollar cost averaging.
Yep.
My question to you is how important are macros to actually factor in? And do we really need to listen to the news or can we follow suit with some of these other investors who listen to nothing?
You don't need to. I just do it because it's a personal hobby and interest, and it doesn't impact me. There, opinions one way or not, and probably nothing more than a habit of it was always playing in the office for years and years, and I just continue to when I'm sitting around and doing it. But you absolutely don't need to. Funny thing this week, Ari, was I always use this indicator when the morning talk shows, things like the Today Show in the States and Good Morning America. Oh, when they have a segment on about the market, the stock market crashing, I love it. Good news. Once it starts hitting the mainstream like that, not saying it's a bottom, but you know you're getting closer. You know you're getting closer. So those are just some of the macros. I just listen to that, just always sensing the environment around me.
Sure. So I, like myself and many other investors, typically hold a lot of dry powder for these corrections or the potential, the recession that we're waiting for, the market bottoms. Now, last year, and I'll just out myself, I held about $25,000 in dry powder, just waiting maybe something was going to happen. Now, I was investing all along the way. Don't get me wrong. I was still dollar cost averaging, just had that
Good.
on the side. Now, looking back, okay, we were up in the S&P at least 23%, 22, 23%. And at the end of the year, I'm like kicking myself in the face. So this year, a little bit different of approach for myself. I'm curious to get your standpoint on how we should go about dollar cost averaging or holding dry powder on the side. If so, how much should we be holding on the side for a potential X, Y, or Z?
Yeah, I don't. It's interesting. It's an interesting topic. For most of my investing time, I had never held dry powder. I reinvested every dividend that went in, so I didn't even have to make a buying decision with it. Maybe I had a few $1,000s on the side. Don't you know about, I wouldn't say a year ago, it's March already, May or June of last year, I'm in an 18 to maybe 20% cash position right now and have been. So that's why I just sit back as a tiger and pounce. That's worked for me. It helped me reduce some risk on my portfolio. Some of this cash was from larger rollovers that I had made. Came over as cash, obviously. I've just been reinvesting at dollar cost, averaging it into funds. Um, I even did a rare thing for me that I hadn't done in probably close to 10 years. I did a trade, scalped a trade and caught a triple in 30 days on a stock, took a asymmetrical risk on it, but I had the ability to withstand that. So how much should an individual person know or hold? Um, for me, I never held cash. Everything, it was all hands on deck the whole way through up until recently. So it's a newfound venture to me. I could break out my former CFP standpoint and read you something that the CFP board would have wanted me to read from a full disclosure standpoint. That a person should hold 5% in cash in a portfolio to be well diversified. I never did. It worked out fine, but I think um, if it's a true bear market, you're never going to have enough cash on hand. You can't outbuy a long bear, and even we're going at this for 4 weeks now in this downturn. Oh, first week it's no problem. Everyone buys the dip. Week two, oh, bought a little bit more. You get into week three, week four. This is where it starts separating. It demoralizes you. You run out of money. Um, you bought something 2 weeks ago. Now it's 5-10% cheaper. And like, why did I do it? Then you really get gun shy. Don't want to do it. So you could want to either run out of the cash you built up, or the cash creates this false security blanket that you still don't take action with. So what good did the cash do to begin with?
I love that. Tom, I got two more questions for you. The second to last question I have for you is over your 30 years of experience in the industry, even now to this very day, what would you say has been one of your biggest mistakes that if you were to go back in time and could have corrected it, it just could have set you up far better for success?
Yeah. The one thing, I wouldn't say it's a mistake, but be thinking of what you own and where you own assets. So I was very fortunate good retirement savings plans I was in, how I invested it, what I invested in IRAs, and just proportionally, it might be hard to see when you're in your 20s or 30s, but the amount of money that you might have in taxable accounts, take that into the equation a little bit more. What do you want to have inside? Because you have true control over that at any given age. You don't have to wait till 59 and a half to start withdrawing it penalty free. Oh, and I know there's someone out there in your great audience that's going to say, oh, no, that's not true. Before age 59 and a half, you can do what's called the 72T and take out periodic equal distributions based on your life expectancy. Great. But that's my point. Not having to do that, the flexibility in taxable brokerage accounts too. So I would just think of not what you own, think of the asset location, your allocation, where you own certain things.
And now my final question for you. It's my favorite question to ask everybody who comes on the show. If I were to throw you $10,000 right now, Tom, to invest it in any stock or ETF of your choice, how would you invest it?
Mm-hmm. Okay. Do you want I can give you two answers, okay? I'll give you two. All right. So one is
We want them both.
one is one one is Riverboat Tom, the gambler. I would buy, so the speculative stock I picked was BBAI. It's an AI stock. I rarely do this. I'm coming out of character. I've even done it on my podcast. Um, I know it felt good. I like it. I'd buy that for a point or two move. It's only $10,000, not much to me. I'd take that and probably maybe write a covered call, pick up income on it, throw the covered call income into Realty Income Corp so it throws me more. That's one aspect I do. No, the other thing I do, the kind of button down Tom investing tiger, I'd put 75% of it in my two ETFs. And then the other $2,500 I would deploy strategically based on, like I just said, I would focus on Kava right now, Tesla, a couple of the growth names, probably wouldn't add some of the value or consumer names that go overinflated. So I would do one of either of those two things probably. But yeah, we can talk after the show, and I'll show you where you or the audience can send that money, and I'll show you exactly what I do with it.
There we go. Investors, thank you for joining Tom and I in another go round of Masters of the Market. Of course, like I mentioned, Tom has an amazing X account. So that link to his X account will be down there in the pinned comment in the description. Highly, highly recommend to go follow Tom on X for those insights. Tom, I want to personally thank you for joining me on Masters of the Market and all the insights that you shared with us. And investors, until the next go round of Masters of the Market, we'll catch you in the next one.